Hello, all. Thank you for joining us today. Hope you had a great lunch. So, today's webinar is about multibaggers, characteristics of multibaggers. Can you know in advance if a stock is a multibagger and the perils and dangers associated with multibaggers if you focus on them too much? Every investor wants to find a multibagger and profit from it, but we turn a blind eye to these points. So today's webinar will be taken by Rajat Setiya, co-fund manager at iThought. He'll be taking you through the presentation. Without wasting any more time, I'll pass on the podium to him. Thank you.
Thanks, Tarun. Good evening, everyone. Thank you so much for joining us on a Saturday evening. So today's topic is multi-bagger stocks. Is it really a reality or the allure of investing? And we know that anybody, especially who is investing in small cap arena, is looking for multi-baggers. And the search term on Google gets lots of hits whenever small cap index is doing well. So we'll deep dive into the presentation and talk about all about multi-baggers. What about them? How many multi-baggers has India generated? What does the global study say about it? And is it really possible to find multi-baggers in advance, or they are only found in hindsight? What are their characteristics? Is the journey of riding multi-baggers easy one, or it is filled with a lot of volatility? And why are we so obsessed about finding the multi-baggers? And what do we do at iThought? Do we really approach small cap investing from the multi-baggers perspective, or we have another way of approaching it wherein multi-baggers is not the focus, rather the outcome? Let's get started. So what really is a multi-bagger? So this term was coined by legendary mutual fund investor of our generation, Mr. Peter Lynch from USA. So multi-baggers, the way we have looked at it from iThought's perspective, it's a combination of three terms, the three variables, two of them being quantitative and one being very qualitative in nature, one behavioral aspect of having a multi-bagger in portfolio. So the two quantitative terms are largely earning growths, which is your profit growth, and your PE expansion. Like what is the multiple valuation expansion that you see in the in a stock in its journey, and
Excuse
then
me, sir.
lots of patience. Yes.
So the slide is not seen.
Oh, really? Just a second. Okay. Is it visible now? Is it good now?
Yes, sir. Now it's visible, sir. Yes.
Oh, okay. So was it not visible right from the beginning?
Yes, sir. Like I thought it
Oh,
was
okay.
yes.
Okay. All right. Maybe some hiccup at my end. I'm really sorry for this. Okay, so let's so we were talking about multi-baggers, like the term was coined by Mr. Peter Lynch, and what are the key variables or key factors that really define a multi-bagger and the way we look at a multi-bagger from iThought's perspective. So if we look at some of the data of the multi-baggers of the last 10 years in Indian markets. So we looked at all the companies which have given more than 25% returns over the last 10 years. And there are about 125 companies which have been able to do that. And these companies were of a certain size. The entry market cap at the time of 10 years back, it was more than 100 crores. So all these companies put together, around 25 companies, they have been able to generate on an average 30 to 33% annual return. So we are calling them multi-baggers. And if we had invested in them on an average, 1 rupee invested in them would have become 18 rupees, which means 18 bagger. So like we discussed on the last, or we showed on the last slide, that multi-bagger is a combination of quantitatively these two factors. So let's look at it. What does the data says? If we look at profit part, it has grown by 6 times. So 10 rupee profit has become 60 rupees almost, which means 6 times earning expansion. And if you look at valuations, it has gone up by 3 times. If the entry multiple was 8x, by the end of 10th year, it has become 25x. So essentially, 3 times multiple expansion, and the multiplication of the two numbers is giving us 18 bagger. So 6 into 3. So we can see that it is not just the profit growth, it is also the multiple expansion, which becomes a significant factor in the generation of a multi-bagger. And this equation, mathematical equation, is also telling us that focusing a lot on entry valuation makes it very critical in generating multi-bagger. So this was all about the quantitative aspects of the equation in the multi-bagger. We'll also talk about the behavioral aspect, which is patience, in the coming slides. Let's first look at a global study done by Jenga Investment Partners on multi-baggers. So they did a study on all the companies which had market cap of more than $50 million at the beginning of the 10-year time period. And if you look at it, India comes on top with 91 such stocks which have given 25% minimum returns on an annual basis over a 10-year time period. And this study was done between 2012 to 2022 time period. So India has been able to generate most of the multi-baggers way ahead of USA and Japan and China, indicating the attractiveness of Indian stock market. This slide basically will help us understand how many multi-baggers of a certain size India has been able to generate. Previous slide had multi-baggers about India, which were, the market cap, starting market cap was around 400 crores. But here in this slide, we have taken starting market cap as 100 crores. So number of multi-baggers that India has actually generated, and this time period basically is 2013 to 2023. So Indian markets have generated a lot of multi-baggers. If you see in the last 5 years, 700 stocks which have given more than 25% returns. In the 10-year time period, the number reduces to 550, and in 20-year time period, the number reduces to 170. So, so basically, as we elongate the time period, what we can see is that it is not easy to continue generating 25% return on an annual basis. Number of companies which can do that comes down. So there are a couple of insights or a couple of observations that we can take away from this table. One, Indian markets are really generating, because India is still in its growth phase, and we are able to have so many companies which are generating such fantastic returns. Secondly, if you see, one out of three companies, almost one out of three companies in the 10-year time period or 5-year time period have been able to generate 25% returns, which means it is such a fantastic asset class. Equity can really create wealth, and this is the testimony to that. And in terms of how much money it becomes, let's say if you had invested 1 crore at the beginning of 20-year time period, after 20 years, that 1 crore has become 87 crores if we had invested in one of those stocks. And similarly, over a 10-year time period, 1 crore has become 9 crores. There is another important takeaway from this slide, and that is, as a company gives 25% annual returns over a 5-year time period, we see that it is not easy to continue making that kind of money in the next 5-year time period or in the next 10-year time period. Number of companies are reducing, which means when a company starts to gain attraction from the markets, its share price starts to move up, its earnings are going up, its multiple is expanding. Slowly, it will become expensive, and the returns from there onwards may not be that easy to come by. And even earning growth may not continue to happen. So there will come a time when you will have to take a hard decision of selling the stock. And that's why selling also becomes important in most of the cases. Moving on, these are some of the names which have gone on to become multi-baggers. Some of them have become actually 100x over the last 20-year time period. So why are people so really obsessed with multi-baggers? Does it really make sense, or it is just something that people are crazy about? Well, if you look at some of the legendary investors and how a great multi-bagger has contributed to their journeys, to their portfolios, one or two stocks have actually become 100x or 1000x for some of them, and they have contributed immensely to their portfolio or wealth creation. If you invest a few percentage of your stocks in a company, of your portfolio in a company, and that goes on to become 100x or 1000x, you can imagine the kind of wealth it will generate. So yes, multi-baggers are able to generate that kind of wealth for you, and even one or two stocks can create that kind of impact that, having invested only few bucks, or let's say 3, 4, 5 percentage points initially, that can become actually majority part of your portfolio. So what are some of the characteristics? So we looked at some of the multi-baggers outside our portfolio, within our portfolio, and what are some of the characteristics? Either they make high return on capital. Business is so strong that if you invest a certain amount of money in that business, you are able to take high amount of returns on an annual basis. So either that, or the quality of business has started to improve after going through a tough phase initially. So either you have high return on capital or improving return on capital. And then you need to have some tailwinds. Yes, earnings have to grow. We have already seen that in the equation, but you need to have certain tailwinds. Those could be in the form of geopolitical tensions which are happening right now between a lot of countries among the in the world, and India is getting some benefit out of that. Or there are some industry specific tailwinds within India, that certain industries going through a good time, or it could be completely company specific reasons that a company is going through a very good time. So we need to be able to catch those tailwinds. Then comes the management part. You need to partner with, a company should be run by a guy who, or a team who has displayed ethical behavior and who has displayed prudent capital allocation behavior, because the job of the owner is really capital allocation. How much capital, where are they deploying, and whether they are deploying it prudently or not. So we need to look at that aspect, whether the execution has been top notch or not. Then comes the one of the most important part, which is having strong balance sheet. Any company, no matter what, and we will look at that, any company goes through very tough time phase one time or other during their business cycle. So when you are going through a tough phase, you should be able to take care of your operating expenses. You should not be under the pressure of returning money to the bankers. There should not be debt on the books. If there is debt on the books, majority of your time will go into arranging funds and take care of the bankers' requirement, which a crucial time which could have been spent on the business in navigating a tough time in the business cycle. And that crucial time is getting spent on the banking activities and taking care of arranging the funds. And we have seen such companies find it difficult to manage their business operations, and sometimes they go out of the business, they become bankrupt. So if you do not have a lot of debt on the books, rather you have cash on the books, that takes care of this problem. And that's why a company goes on to become a multi-bagger, because they continue executing year after year, especially as soon as the tough time gets over. Then comes, if you get all the first four parts right, I think then in our view, having good entry valuations become very important. And we have seen this is also an important part of the equation, wherein we have seen that multiple re-rating also contributes around 1/3 to the generation of returns. And this is what has happened in the last 10 years with Indian stocks. And you might have to be early in the story, because it's not that once you invest in a company, it will start going up right away and it will become a multi-bagger. It will have its own journey of ups and downs. And most of these multi-baggers are under-owned, which means they are not really owned by institutions at the beginning. Of course, a lot of funds, a lot of mutual funds will come later on, but usually during the initial time periods, these are not really owned by a lot of big institutions. So now, having seen some of the traits of a multi-bagger, let's look at where do we find them. Again, we take cues from the quantitative part of the equation and also, of course, from the behavioral part of the equation. So you want to get into a company which can grow its earning multifold and its valuations are attractive. So how do you get this combination? You can't get this combination from a company which is growing right now immediately and and it's cheap also, and it's decent in size as well. Well, this combination is difficult to get by. So what really happen? You have to look at companies which are going through their lows, which are sectors or companies which are neglected today. For example, real estate construction has been a neglected sector from 2010 to 2020. If you look at IT in 2019-20, it was a neglected sector. If you look at capital goods, similarly in 2017-18, it was one of the most neglected sector. Similarly, you will have some sectors at any point in time which are neglected. So you look at those sectors and you try to find a company or set of companies which are doing good. Sometimes a company or a sector is going through a bad time, temporary problems, a sector or a company may be facing. So that can also be a good time, because whenever you see a company which may not have a very attractive or very positive view, positive outlook on the earnings in the immediate 3-4 quarters, which is where the most of the markets participant usually focus. That's where you will see the value. That's where you can uh, you can find a spot to make some money better than the markets. And those companies, if they meet the other criterias, and you know that the problem is temporary and earning growth is going to come back, that's where you hunt for value. That's where you hunt for some of the good returns. So these are some of the areas where you can find them, and we have seen multi-baggers have come from almost every sector. Every sector will have a company or set of companies which have done really well. And finally, yes, so far I have said it is not possible to get the combination wherein you get everything on the go. But yes, sometimes you do get it. But those are usually very small companies where, you just need to read some annual reports or attend some AGMs. You need to put in that kind of effort and you get that. Yes, you get sometimes very good stocks right on your platter that, they are simply undiscovered. They have everything. You just need to reach out to that annual report of that company and read about it and understand it, and then take a call. So can you really identify a multi-bagger beforehand, or is it really in hindsight? In our view at iThought, we feel multi-baggers are very difficult to call out right on day one. On day one, you can really look at companies which can probably give you 70, 80%, 200% 100% kind of returns. But will they really go on to become, you know, 3x, 4x, 10x? It's really, really difficult. But why is that so difficult? Because the two important ingredients that we have talked about, quantitative ingredients, which are earning growth and multiple expansion, it's all about future. And future is very difficult to predict. And importantly, even if you get a multi-bagger idea in your portfolio, you need to have patience. And why patience? We'll talk about it. What are some of the challenges? We see a lot of obsession about multi-baggers. Everybody talking about multi-bagger. Nobody wants to invest in today's time, especially in a company which can give you 15% kind of returns on an annual basis. Everybody wants to invest in a company which can give you 25, 30, 40, 100% kind of return in, immediately first year or second year of your investment. But why such an obsession? And what are the challenges for that of that? So if you look at, one of the main problem that happens while hunting only for multi-baggers is that you end up losing sight of entry valuations. What usually happens, market participants tend to go after companies which are doing well, companies which have already done well. They think trees will grow to the sky. Something which has already done well will continue doing well for infinite time period. Well, that is never the case because trees never go to the sky. And what really happens in the process, you end up violating one of the most critical aspect of finding a multi-bagger or finding an opportunity where you make good money, which is entry valuations. You end up investing in a company which has become expensive on valuations. So, well, this is what the data says. If you look at last 10 years of share price study of Indian companies greater than 100 crore in market cap at the beginning of the period, you see companies which have generated 10-year annualized returns of 25% or more, their entry valuation was 15 times. Price to earning ratio was 15 times. However, if you look at the companies which have given less than 10% annualized returns, their entry valuation was 36 times. So this explains everything. Why entry valuations play a crucial role. Then what else happens if we are really only obsessed with multi-baggers? We go down the quality curve. Well, some people think that they do not want to pay up. Then what really happens in the process is that for hunting right valuations, you end up going down the quality curve. Because you are only focusing on one aspect of the equation, which is valuation. The other aspect, which is a good company growing its earnings, gets compromised. You end up investing in companies which are not really good. Then some people like to go after turnarounds because in a turnaround situation, if that plays out successfully, earnings can grow multifold. But as people say, turnarounds rarely turn around. So even that becomes a problem. However, there is a data point which suggests we don't really have to go after turnarounds. So what does the data says? That as per that Zynga partner study, 82% of the companies which went on to become 10x in the 10-year time period were actually profitable. So we don't really have to chase turnarounds. And then what's the next mistake that can happen is that you end up chasing the most hot theme of the year, of the time period that you live in. So in today's time, we believe SME stocks, electric vehicle related themes, or the companies, or EMS, electronic manufacturing services companies, that is a theme which is really hot, and their valuations, you can see entry valuations are just not in our favor. Similarly, such cycles we have seen in the past, that real estate infra used to be the hot theme in 2007, and that's why in the last 10 years they haven't done really well, because 2007 to 2010 they made a lot of money and valuations were so expensive that in the construction infrastructure sector 90% of the companies have become bankrupt. They took a lot of debt, their valuations were expensive, and 90% of the value has already been eroded. So whenever such manias come, we end up get sucked into such manias if you are not really focused on your core process or philosophy, and you end up losing a lot of money. So these are the challenges. So what should an investor do? I think in our view, it's just sticking to the basics, that you get the right company, right management, and balance sheet should be strong, and your valuation should be uh, in the right range, that they are not expensive, they are either fair valuations or attractive valuations, or cheap valuations, without compromising on the business quality. Now comes the next part, which is patience. So we will now talk about more about behavioral part of the multi-bagger equation. So what does this equation says? That we should have earning growth, we should have multiple growth, then lot of patience. Why do we need to have patience in this equation? What is really the role of patience? So let's look at some of the disturbing data points. So far, we have seen data points which are pointing that we can make a lot of money in Indian markets, in stock market. There can be a lot of multi-baggers. But now let's look at some of the disturbing data points. So what does the data say? Is that even multi-baggers have bad days, which means the journey is not smooth. It's filled with a lot of volatility. So what is that volatility? You look at some of the best multi-baggers of the last 20 years. Some of these companies have actually become 100x over the last 20 years. 100x. 100, 1 rupee invested has become 100 rupees. Just imagine the kind of money they have generated. Despite that, 50 more than 50% of the times these companies have given negative returns on a daily basis. So it's not that the journey is going to be smooth. Now let's look at a chart of one of the most successful consumer brand in the domestic consumptions theme in India. This is a homegrown brand by staples of Tata, Titan. We are talking about Titan here. Uh, if you look at Titan's share price, and you know that Titan has been one of the most successful company and the wealth creation business in India. From 2005, this business has seen drawdowns to the extent of even 60% at one point in time. And if you look at drawdowns of 30% multiple times, drawdown of 20%, you will stop counting the numbers because it has also fallen that much a number of times. So it's not that if you have identified a company which you think can become a multibagger will only go up. It is also bound to come down in line with the market conditions, in line with its business cycles. Sometimes a company has to go through a bad phase as well. And we have talked about that it happens and what should we do or how we can take care of such things that by investing in companies which have strong balance sheets, strong management teams. So we know that patience is important, but how do you really back your patience during such difficult times? If you see 60% drawdown, this is really huge. If you invested 100 rupees in this company, it has become 40 bucks, or some of the time it has become 70 bucks. So how do you really back your patience? By doing as thorough due diligence as you can, by knowing the company better than anybody else in the country, and understanding the core of the business rather than focusing on the headline numbers, which is revenues or profits. One should also focus a lot on the qualitative aspects. What is it that is really causing the problem? Is it solvable or not? Is it temporary or permanent in nature? Yeah, those kind of things if you focus on, then then what you can really achieve is that the story better than anybody else, and the story that which in which direction it is going to play out. And if you are really able to do it, then you will be able to understand what kind of you know quantitative numbers will come up in the next few years. So the journey doesn't mean that the story numbers will start coming up right from day one or you won't see drawdowns, but it helps you during those tough phases to hold on to the company or increase your position during those times and not get out of the company during the tough phase. So so here comes the most important aspect we have realized in portfolio management, and especially in the small cap space and in a journey of multi-baggers, which is portfolio nurturing. So how do you really? There are two aspects to that. The first is that seeding the positions in a small way. We have a strategy at iThought of investing in companies in a, you begin the investment at a very small scale. You closely track the company. You go through their conference calls. You try to engage with the managements on a one-on-one basis or in group meetings. You engage with the competitors, suppliers, try to interview some of the employees, ex-employees, or the management teams of the competitors. You attend their AGMs and do as thorough analysis as possible on the whenever the numbers come out on quarterly basis or annual basis. So you track the company closely, you see what is happening in the industry, and as you build more conviction, you increase your allocation in that company. And through one live case study, we will also show you what we did and what how we really do it in our portfolios. So as you nurture a company and as you closely track it for years, your conviction goes up and you end up investing more in companies which are going through a good phase, which are able to execute better than what you really imagined. And some companies will not be able to stand up to your expectations, which means their execution may be poorer than what you expected. And the external factors may also hurt them badly, that sometimes repair is not reversible, damage is not reversible. So you end up So through the strategy of seeding the positions in the portfolio, you end up investing more in good businesses rather than in bad businesses, and you end up tracking the company much more closely before investing a lot of money in that. So whenever such drawdown phases come, you have a lot of convictions and you are able to not only hold on, rather increase. And this is exactly what happened in this company and many more such companies in our portfolios. So this is a live case study of a portfolio company called TD Power. So this company is into the manufacturing of generators for the small power plants, which are needed by industries, heavy industries like steel or cement and the likes of that. So this company, at the time of, this company basically is a market leader in their field. It had debt-free balance sheet when we invested in this, and rather they had a lot of cash on the books. It was available at very attractive valuations of less than one time book value. Uh, it is run by a management team which had displayed a fantastic track record of execution. This company got listed in 2010-11 time period, and at that point in time, it was only a one product, one geography, which was only India. It was only a one product, one geography company. But what happened over the next 7-8 years, they expanded into export markets, they added new clients, they added new products, and hence new applications. So they diversified the business a lot. They had to do it because Indian markets where they were selling and the only product they were selling went through, the end market went through a very bad phase. The capital cycle India has been only on the way down in the from 2010-11 to 2020, rather 21-22. So 10-12 years of downturn, and this company burned actually faced a lot of heat during that time, and they had to go through a down phase. That's when management stepped up. That's when their character showed up, that they diversified a lot. So we first looked at this company in 2016. However, we invested in 2018, so we were already tracking this company for 2 years. So what really happened after we invested in this company? So we invested in this company when it was cash rich. Its valuations were less than one time book, which is really very attractive valuations for any capital goods company. Despite such attractive valuations or such fantastic execution by the management, look at what happened. 2 years flat returns, rather not flat. Sometimes it even went down, went below our uh, entry share price. But we had invested only 2% of our portfolio in this position to begin with. And then COVID came. The stock went down by another 50%. So overall, 2.5 years, and you are down by almost 50%. So what did we do? How did we get our conviction? We have talked about it, that you need to be as thorough as possible. However, if you look at some of the numbers we have laid down at the table below, from 2018 to 2019, company had started showing good results. Even in 2018, when we invested, numbers were still not visible. However, because of our research and study, we had the comfort that company can do well. But still, we wanted to see some execution before we could ramp up. And that's why we initiated with the small allocation. But in 2019, if you see, even on flat top line only grew by some 20 crores within a year, which is around 5% growth. Margins expanded. They exploded from 2.3% to 6.5%, more than around three times growth in the profits. This was a very good validation of our thesis. However, stock was not doing well in 2019. Same thing happened 2020. Performance continued to go up. Again, market did not validate that. Share price went down, like we said, by 50%. It was COVID related correction also. So what did we really do during this time? We were pretty sure that the company is on the right path. Numbers were also showing up. So what we did was we increased our allocation. We started with as low as 2%, and we increased our allocation to as high as 11-12%. And we not only participated during the way down, that when stock was down, we averaged down and we reduced our holding price, but also on the way up after 2020, also when the company continued doing well and the stock price started going up, we could see value in this business, even at those levels of price, because the valuation was still attractive. Valuation had no price had gone up, but valuation was still attractive. There's a lot of difference between share price and valuations. So price was going up, but valuation was still attractive, and we started averaging up as well. Overall, we invested 11-12%, and the very fruitful outcome. And this company went on to become, like we discussed, that one or two stocks can actually create a lot of difference, and this stock actually created a lot of difference for Vriddhi portfolios. It went on to become a 10 bagger for us, and we still own this company. We have reduced our position, but we still own this company in major quantities, because we still believe that the company can do really well from here onwards as well. So if we sum up everything so far what we have discussed, and if we put it from our lens, what do we really do at iThought? And we talked about it during the last slide, during the case study of TD Power. What do we really do at iThought? We do not focus on multi-baggers. We do not focus on the right side of the equation, which is having a multi-bagger. Rather, we focus on the left side of the equation, which is focusing more on the inputs. What are those inputs that we need to do, that we need to put in? That you need to invest in good companies which can grow their businesses. So we don't really focus on returns a lot, that we need to invest only in companies which can become 2x, 3x, 5x. Rather, we focus a lot on certain ingredients that we have talked about, because that helps us in reducing the risk. In investing, it's all about risk and return, and you cannot wish away the risk in investing. So what is it that you can really do in investing? You can control the risk, you can manage it. You should not let the risk part take over your investing in chasing returns. So don't chase returns, focus on risk and reduce it as much as you can. How do you do it? We have talked about it. The kind of traits that a multi-bagger idea has, you need to focus on those things. So we focus on entry valuations. We focus on base rates, that base rates of uh, entering at a high valuation and making returns is very poor. So you be cognizant of it, and you keep your expectations low, and you go in with a very conservative mindset, and if you end up investing in a company at attractive valuations. So focus is just not on multi-baggers, rather it is on the process, and we'll talk about it in very briefly, because so much whatever we have talked about so far, it's everything put together is what is our process and what is our philosophy. So we focus a lot on our philosophy, a philosophy which has worked for us over the last 10 years, and we continue sticking to it. We have refined our philosophy, we have done the tweakings needed as per the market conditions, as per our learning that we have had over the last 10 years. And we feel this process is becoming more robust as years go by. And we continue to stick by it, because sticking to this philosophy and the process is what really is creating good outcomes for us. But this is what is really creating multi-baggers for us, despite not focusing on that. So what are some of the traits? What were some of the traits of multi-baggers that team Vriddhi at iThought has been able to identify? So they had very strong balance sheets. No company had one uh, one times debt to equity ratios, which means and this one times debt to equity ratios is considered a safe threshold to have. Anything above that is considered risky. Anything around that is considered safe. But no company had this kind of debt to equity, which is still considered safe. And half of the companies, there have been 21 multi-baggers, and half of the companies uh, were cash rich, which means they were very, very safe companies to invest in, and still they generated multi-baggers. At the time of the investment, 5 years prior to the investment, you can see the profit growth of those multi-baggers was 15-16%, and after the investment, the growth was 38%, which means we were able to identify certain triggers in those companies, certain tailwinds in those companies, that earnings can grow at a faster clip after we invest. So this is exactly what happened. And because earning growth was much faster, you can see the return on capital, which was already strong at the time of investment at 15%, went on to become 22%. And now comes the other important quantitative part, how were the valuations? You see, in deep cyclicals, we have invested at around one time book value. Some of them were below book value. Some of them were 1.2, 1.3 time book value, which is considered very, very attractive. And some of the other companies, which were not cyclicals, and they were good quality cash rich companies, going through temporary you know temporary downtimes in their business or down cycles, or they were coming out of a tough phase already, like TD Power in 2018-19, it was coming out of a tough phase. So we were able to buy such companies at 15 times their profit or operational cash flows. So in a way, all in all, uh, we can say that the valuations were really attractive, and this is what really makes a multi-bagger. So this is our philosophy. We have already talked about it. All the five factors that we have talked about are really the traits of the portfolio multi-baggers that we have had so far. And this is what we try to stick to on a daily basis. We have created a process, investment process, which helps us focus on the philosophy day in, day out. The process is such that, the job of the team is to kill the idea which has been presented on the table. The job is to play devil's advocate as much as possible. Job is to find the flaws in that investment thesis which one of the team member has brought on the table, so that we are more aware about all the pitfalls in that investment case, all the blind sides that the guy presenting the idea might have. And this covers the risk part. And this is what we have talked about, that we focus on risk, not on the returns. So, investment philosophy in action, that, as of today's Vriddhi portfolio, almost 60% of these companies are debt free. We are not talking about decent level of debt. We are saying debt free. They do not have debt. They are rather cash rich balance sheets. 21 names in the Vriddhi portfolio are actually market leaders. Either they are number one, number two, or number three in the respective field of their operations. And like we have seen some of the traits of multi-baggers, that they are under-owned, they are not really owned a lot by mutual funds, which means there is not much external research coverage on these companies by equity research houses. Almost 60% of Vriddhi portfolio companies are like that. So all of this really helps us in controlling the risk, is what I have been saying so far. So how did it really show up during the tough times in the market, the risky times in the markets? If you see, uh, year ending 31st March 2023 was a bit of a down year for the small cap space. And how did we do during that time? So during that time, NSE small cap index fell by 14% and Vriddhi portfolios were up. And if you see during the time period, the peak was made in October 2021 and bottom was made somewhere around March. And during that time, from peak to bottom, Nifty small cap index fell by 32% and Vriddhi portfolios had correction of only 17%. So while we had also fallen from peak, but we fell much less than the market, and this is what creates a lot of difference. This is what we call risk management. And this saving of money, market falls by 30%, you fall by 15-20%, you are able to save that 15-20 bucks. That 15-20 or 10-15 bucks basically helps you creating outperformance during the up markets, because when markets are going up, everything is going up, everybody makes money. Nobody is spared from the good luck. Everybody makes money. It is only during the bad times that you need to have risk control in process in your process, risk control in your portfolio. If you have that, that actually goes on to become the bedrock for your outperformance overall in a 5-10 year time period. And this is exactly what we have seen time and again, which is working for us, that whenever markets are falling, touch wood, we have been able to outperform, we have been able to save the money for our clients. And every penny saved during those tough times, bad times, has meant that we are going to outperform. Yes, this is exactly what has happened. Some of the score, this is basically the scorecard of Vriddhi in terms of multi-baggers, that there have been 11 such stocks which have gone on to become 2x. And a very quick look at the half year results of Riddhi portfolio. As you can see, median growth has been 18% and median EBITDA growth, profit growth has been 34%. Well, last year was completely opposite for Riddhi portfolio in the sense that profits were growing at a lower rate than the revenues, because last year was marred by a lot of cost uh, inflationary cost going up and profits being affected. However, sales was robust last year also, and it continues to be robust in this year as well, because our economy is really going through a good time right now, and we are seeing benefits in our portfolio companies as well. And this year, all the inflationary related costs are under control, and companies are also able to pass on those costs to their customers. So this year is seeing a very good growth in their profits. In fact, almost half of Vriddhi portfolio companies grew their uh, profits and sales by 25% in the first half year of 2024. Well, this brings us to the end of our presentation, and quickly summarizing what we have talked about. First of all, having a multi-bagger is not the focus, it's not the input. Multi-bagger is always an output of three variables. One is your earning growth, second is your multiple growth, and then how much patient you have been during that journey, because you have seen how many drawdowns happen and you need to be patient. You need to know your stock very well, that you can be patient and you can hold on to the stock. So, and it is very difficult to predict some of these things. So you need to control what you can control. What you can control is the quality of company you invest in, quality of management team you partner with, business balance sheet, how strong it is, and the entry valuations, because entry valuations are really important. Once you get this combination, then you need truckloads of patience, which is backed only and only by your analysis and your research. Despite that, it becomes difficult, and that's where having a sounding board, having a process in place really helps, because you are acting as a team, not as an individual. You are supported by your team in terms of having that patience and having that kind of conviction. And tracking a company and doing a thorough research really helps you. And having that strategy of seeding the positions in a small way and then increasing allocations over time as you gain more conviction is also a very powerful tool that we have identified over the years. And that's where, we meant when we said that, our philosophy, our process is getting strengthened year by year. And this is another thing that we have learned of lately. And finally, we are not really obsessed by multi-baggers. It is the outcome. We repeat, it is the outcome. It is not the inputs that go into uh, doing something. It is the outcome. And an input is sticking to your process. Everybody knows what is the key to staying healthy. It's eating healthy food, having a healthy lifestyle, sleeping in time, getting up in time, and doing some exercises on a daily basis. But how many of are actually able to do it? We know the answer. And how many are actually able to do it on a consistent basis? We know the answer. Same is the thing with investing. We know what works. We know what doesn't work. So doing it on a daily basis, consistent basis is the key. And it's really difficult. And that's where having a process, having a philosophy, having a structure in place which enforces this kind of discipline is the key. And touch wood, we have been able to have that kind of process in place. And finally, I'll end with the last point that with the portfolio, we have been able to walk our talk. We whatever we preach, we have been able to practice it in our philosophy in real terms. Well, with that brings us to the long presentation. I'm sorry for taking so much of your time, but now we are open for questions. Anybody who has any question, we are more than happy to take those questions. You can write in the chat box and we'll start taking those questions one by one. Okay, we already have our first question from Karthikeyan. At what stage of conviction building do you start investing? Do you wait for some threshold to start to invest? So investing is all about finding patterns. That debt-free company, growing return on capital, earning tailwinds, all these things you try to find in a company. So uh, after reading so many companies, probably hundreds of them we have evaluated in the last 10 years, and maybe thousands as a team, you try to see some patterns, and you try to understand that, you start to understand that a company is going through a certain phase. There are certain things that you focus on. It can be gross margin increase. It can be like we saw in the case of TD Power, that when numbers started to show up. I'll also talk about before numbers start to show up. Like in the case of TD Power, we saw that in 2019, uh, while top line was flat, margins expanded. What is that? It is basically, cost control. It is basically some sort of pricing power that they have got, or some benefit in the form of material cost. So you see such things. And up until 2018, what was really happening in TD Power? The company was not showing great numbers, but still we had some idea or some sort of conviction that, this company can do well. What were those things? We talked about some of those things, but one really important thing I'll again reiterate is that company had diversified a lot. Management was not sitting idle all these years. The company went through a tough phase from 2011 to 2000 and almost 20, or let's say 19. That's when they started seeing reversal. But 2020-21 is the time period when they couldn't even cross their previous peak in terms of revenues. So 10 year of downturn. So by 2018, it was already sixth or seventh year of their bad time period. But during that time period, they were not sitting idle, that, they have cash rich balance sheet, they will not go bust, so they will just wait for the cycle to turn around, which by the way had started turning just now. So they would have had to wait another 4 years for this kind of markets demand to come up. But what did they do instead? They went to export markets, they went to new applications, they developed new products. They won very prestigious order from Indian Railways of 10-year of contract, which is unseen in such businesses. That you get 10-year visibility of revenues. They got some 700-800 crores of revenue contract from Indian Railways through their client Alstom. So these were some of the qualitative factors which was still not reflecting in the numbers, and hence having a threshold that, if this happens, then only I will do something, may not apply. It applies in a lot of cases. Even in TD it applied, when from 2019 and 2020 and 2021 we saw the numbers and the stock price at the same level, we increased our allocation, or the valuations at similar levels, we increase our allocation despite stock price going up. So we not only use quantitative thresholds, we also use qualitative insights that came up from closely tracking the company for more than 5 years, and we use them to our advantage. And this is what we can answer to your question. Okay, next question is, in Vridhi, are you focusing and holding the stocks to become multi-bagger? Yes, that's what we are trying to do. However, first of all, yes, this is exactly what we are trying to do. Some of the names that we are holding, we have been holding on to those names for many, many years. Vridhi in its previous avatar was under an advisory model. Today, it is in PMS model or structure or license. Some of the companies we continue to own them from the advisory time period, which means we own them for 5 years, and there is no nothing to say that we will sell them tomorrow. We may continue owning them for another 5 years. Only thing is, we should be able to see good risk reward at today's point in time. If we see good risk reward, we will continue owning them. Look at TD Power. We are still owning that idea after it becoming 10x. We are not completely selling it, but we also saw on the initial slide that you need to sell the stocks, because it is very difficult that a company which is doing well will continue to do well for 10, 20, 30 years. It's very difficult. Only 20-year time period, only 150 names have been able to achieve that outcome, while in 5-year time period, the number of companies is around 700 or 750. which means only 20% of such companies will continue to be there after another 15 years. So you need to sell. So we are doing both. From our side, what we are really doing is following the process. What is the process? Process is at any point in time, you evaluate a company, whether it is giving you good risk and reward. What is risk and reward? Risk is that the the valuation at today's time are in your favor or not, and the reward, how much money you can make. So do I have to ask you to focus on my Vidhi PMS stocks to become multi-bagger? Mm, I'm not sure what do you mean by this question. If you can elaborate this second question. Third is, what would be the ideal hold period to stock become to multi-bagger? Well, uh, see, let's look at the profit growth. If you look at share price, it can be very illusionary. It can be very incorrect way of looking at it. While multi-bagger are defined by a share price, but we have seen the ingredients. Ingredients are multiple re-rating and earnings expansion. So multiple expansion and earning expansion. Let's look at earning expansion, because without earning expansion, whatever multiple expands, it is not going to be sustainable. So earnings expand over a period of time. When we invest in a company, we try to go for a company which can double its profits in a 3 to 5 year time period. Sometimes it doesn't happen, and sometimes it is not 2 times, it is even 3 times. And over a 5 to 7 year time period, we look at something which can grow their earnings by a company which can grow its earning by 3 to 4 times or 2.5 to 3 times. So that's what you ideally try to look for. So there is no ideal holding period as such, but that's what you target. And companies have their own business cycle, so they may or may not perform during that time period. And sometimes they are ahead of it, sometimes they are behind it. So nothing ideal as such, but the pattern says that 3 to 5 year time period is good enough to own a company to make it a multi-bagger. What are the nuances of holding or focusing specialty chemical stocks? What are the risks in this sector? Well, this is very specific and can take a lot of time. So I'll quickly say that it is not just specialty chemical stock, or rather, this is a very generic answer because this is what you really try to focus on. You try to focus on some of the things that we have talked about, and you try to see that valuations are always in your favor at the time of investing the money in that company or sector. However, some companies, not some companies, but every company or sector goes through its business cycle. And that's where I think this question comes, that specialty chemicals, so how do you track them? Because today they are going through a bad time. So I think it is difficult to predict the earnings, and that's why it is difficult to call out a multi-bagger in advance. So you need to get other 3 4 things in your favor, which we have talked about. That valuations, balance sheets, management teams. So if you get all of those things right in your favor, and even if you don't have the earning visibility, but you try to gauge that next 3 to 4 years at least earnings can definitely revive, that's when you invest. Otherwise you don't do it. If you are not able to understand it, it doesn't make any sense to invest. In the prior to election year, what to focus as investors? Do we need to invest more? Well, we don't need to do anything different than what we have talked about. Nothing we need to do different, be it election, be it anything else. We have learned even in COVID time period, we didn't have to do anything different. At that point in time, when it struck to the world, everybody was facing it for the first time. Nobody knew what to do. But in hindsight, with the benefit of hindsight, we can say even at that point in time, nothing else needed to be done. You had to continue focusing on your process, sticking to your discipline, continue doing what you have been doing so far. And we have talked about it, and we just need to do the same, nothing different. Uh, do you need to invest more? Well, that depends on your liquidity and the situations in the markets. Uh, we keep coming to you, telling you whether we need more money or not. This is what we do, whenever we have a new idea to invest, or more money to invest in existing ideas. Yes, we come back to you and tell you that we need more money and we don't have funds in the account. And you can fund your account with more capital. So that we will continue telling you. If you have liquidity, you do that. But the best way to approach investing, we have found out, is to have a SIP in place. You should continue investing if your liquidity allows you, whatever liquidity permits, you should continue investing on a monthly basis. We do not invest all the clients' money in one go. We do not follow model portfolio approach. You know that. So since we don't do that, which means if there is any excess funds in the account, we are not going to deploy that, irrespective of the market conditions or the ideas that we are getting in. We will only deploy when we have the idea. So from your side, your job is to fund the account, your own account, if you have liquidity to invest. You don't focus on elections or any macro event. You focus on your liquidity, and if you have funds, we will take care of investing the money when we find the right set of stocks. It is not the right set of stocks, it is the right set of stocks at right valuation. That's the combination we want to go with, and whenever we get it, we'll do that. Next question is, at entry you are looking for companies with more than 100 crore, right? But how high of a market cap? Well, generally, average market cap of our portfolio you will see is around 2,500, 3,000 crore, I think. And the largest would be at the time of investment, maybe 10, 12,000 crores, or maybe 10,000 crores at the time of investment. Rather, I would say today it is 14,000 crore at the time of investment. But there are only one or two such names. But we don't really target as such. By design, we know that value lies in small cap space a lot more than large cap space, because you can do some work, you can go out and really find some undiscovered gems. However, we are not denying any opportunity if just because it is high in market cap. By design, we don't spend a lot of time there. 95% of our time gets spent on companies which are probably below 5,000 crores or even less than that. 95 or even more than that, much time gets spent on such companies. So yeah, that's what we do. At which point of time we need to sell a multi-bagger stock and what portion? Well, we must confess, selling is the hardest part. It is really, really difficult job. Buying is not the hardest part. Selling is, and that's where behavioral aspect of investing comes into picture. So what we have identified and observed for ourselves, and we are still learning. We won't say that we have been in the markets for 10 years, collective experience of more than 50, 100 years. So we have cracked the formula. No, we are still learning. So two things. One, if valuations become expensive. So what does expensive threshold here mean? Expensive means from the current level of price, will we be able to, and what we know about the company, depending on our, going by our analysis and our understanding of the company, can we still generate decent returns, at least 15% kind of returns in this company over the next 3 to 5 year time period? If the answer is yes, you stay invested. If the answer is no, you start selling. So this is the second point. We don't sell in one shot. We don't sell in one shot. There is something called wisdom of the crowds, which means crowd as a whole can be right, and rather they are right most of the times. So you respect the crowd. You don't be rigid in your judgment. So what you do is you start selling a little bit, because if a company is really going to go through a earnings explosion, then you will miss the opportunity of staying invested in a multi-bagger despite identifying it at the right time and owning it for some time. So what you do is you start selling, and with every result, you assess, or you try to assess if you are missing something or not. And if you can answer that, the earnings growth is not going to be commensurate to the current valuation, then you start to sell even more. You sell even more. and you increase your selling part. But if you think the answer can be yes, that earning growth can be faster than you imagined initially, then you adjust accordingly, and you stay invested for the longer time period. So that's where actually portfolio nurturing, portfolio tracking comes into picture. So it is not that you set a target price and you sell it. Since you cannot identify, you cannot call out how much returns you will make from a company on day one, so you cannot set a target price. You continue, I would say, assessing it every quarter, if not earlier than that. Every quarter, we definitely do that. Every quarter, we have a detailed discussions around a company, whether we should buy more, whether we should consider selling, or if we are already selling, whether we should consider selling more. And if we are selling, whether we should consider stopping the selling because earnings have been faster than what we imagined. This is a game of probability. You will be somewhere around probability at a whole, at a portfolio level, but at an individual level you will be digressing a lot from the possible outcomes that you imagined. So you need to continue assessing, and you cannot be rigid. You need to readjusting your assessment as per the data. When data changes, you need to change. Well, a detailed answer to your question, there is no right set answer, but this is the process, and this is I have tried to explain the process that we follow at iThought, and this is what we do. What is the minimum amount to enter with the PMS? Well, the minimum amount is defined by SEBI. It is 50 lakhs for any PMS. Actually, it is any PMS that you join. In iThought, there are four PMS offerings that we have. One is Vriddhi, which is small cap. One is Solitaire, which is the flagship product of iThought PMS, wherein we invest in companies of all sizes. Focus is at iThought, in every product you will see the focus is pretty much focusing on risk rather than the returns, and seeding the positions in a very slow, gradual manner, and not deploying the capital in a model portfolio approach. We go by the market conditions. We go by our individual stocks. If we find the valuations right, then only we will invest. So every PMS that we have, it is 50 lakhs. So this was the second offering, and then we have a Sphere wherein we invest in multi assets, and then we have True Blue wherein we invest in best of the best companies, only the top 50 companies listed in India. This product is very much suited for people who want to really go for the very, very safest of the returns and protection of the capital and still make some money. And somebody who's retired and looking for retirement corpus and have excess liquidity, somebody like that can invest in True Blue. So, well, in every PMS, these are our four offerings. Its minimum is 50, and this is mandated by SEBI. Increase in short-term borrowings and increase in long-term borrowings. What is the difference between them? Well, it's an accounting question. I will quickly try to answer it. Short-term borrowings are usually taken for working capital requirements, for day-to-day operations of the business, and long-term borrowings are usually taken for investing in the business, for the long-term investments. So, for example, setting up a plant and machinery and factory, will require long-term borrowings because benefits of that will accrue for years and decades to come. And if you want to buy some inventory on credit and you don't have funds, that will be categorized as short-term borrowings. If we enter low PE like 5 on a stock, should we wait even the negative business cycle starts? I think it is not governed by waiting is not governed by entry valuation. Waiting is governed by the business conditions. You may enter a company at a very attractive valuation, still be wrong. Because if the business cycle, you got the call wrong, you are wrong. And if the management is unethical, incapable, you are wrong. You need to take a call. And so it's not a function of that. Waiting is a function of, we have discussed that at every quarter we try to assess what's going to happen in this company over the next 3 to 5 year time period. So you keep assessing your company the same you assessed it at the time of investment. And if the data changes, you need to change your assessment also. Next question is, what is the starting point to have multi-bagger in our portfolio, and how long to sit patiently? That is, what are the indicators to come out of a multi-bagger? Well, we have talked about all these points, that Starting point, if specifically you have to ask, well, there is not one single point. It is exactly all the five traits of a multi-bagger that we talked on one of the slides. Those are the points. There is nothing else. Actually, there is not one single point. Actually, it is a combination of those five things. Rather, those five things is a very simplified form of putting it out for all of us. But it is many more things under those five things that we have to look at. And when you say what are the indicators to come out of a multi-bagger stock, which means when to sell the stock, we have already talked about it. Agriculture-based company to quality to multi-bagger. I'm not sure what does this mean. If you're asking agriculture-based company will qualify as a multi-bagger, like we said, I'm not sure if this is the question, but this is how I'm understanding it. So, well, multi-baggers can come from any sector, and yes, even in agriculture, we know a lot of multi-bagger ideas. They can come from any. See, multi-baggers is multi-bagger is nothing but an outcome. What is the input? Let's focus on that again. I'm sorry, I'm re-emphasizing again and again. What is the input? Input is earning growth. So even agriculture business can grow their earnings. If first of all, the answer yes, they can actually grow their earnings. So and when that is the case, they can also become multi-baggers. But of course, you need to get the entry valuations right. Yes, this presentation will be uploaded on YouTube, and you can get in touch with your respective advisor to our team, and you will be able to have access to the presentation. Very good presentation. And okay, question is, you talked about multi-baggers in Riddhi. I do not have Riddhi, but have Solitaire. Do you also have the same process here to grab multi-baggers? How about Sphere? Yeah, how about Sphere? Yes, we have the same process. I think approach to investing is the same. We are not approaching multi-baggers. We are approaching a stock one by one and looking at the risk part of it and seeing if the risk is in our favor, and we can make this slight bit of money and we will enter. Multi-baggers, like we said, become only in hindsight. So approach is to invest right, invest in good companies, and try to make above average returns. One thing I would like to emphasize here that because we have been talking a lot that this is the focus, this is the focus. The another way of putting it is we do not try to focus or try to be the best performing fund in any given year. What we really would like to see ourselves doing is uh, performing above average every year. And after 10 years, we know that we will be, or after 15, 20 years, or 10, 15, 20 years, we will be among the top performing funds in the country. We know that. If every year you are trying to be above average and not focusing a lot on being on the top, if you focus on being on the top, it is equivalent to finding a multi-bagger, or focusing a lot on the multi-bagger part. And we have seen the kind of mistakes that can happen. So we don't want to take those risks and commit those mistakes. So what we want to do is we want to focus on doing the right things which have worked for us. Even if that means you may not be the top performing funds, but we have seen time and again, it's been many years of investing now, you end up being above average. You end up being amongst the, let's say, top one or second quartile. And over a period of time, you end up being in the top 10 percentile of the fund. And that's what we have seen with good performing funds over a period of time. That's what we would like to see ourselves. And this is exactly the approach that every other scheme at uh, investment style at I thought is approached with. So it is not just Riddhi or Solitaire. Sphere is also done the same way, or True is done the same way. Our focus is a lot on the risk and very little on the returns, like we said. In a good market, everybody will make money. It is only during the bad markets we need to see whether we are able to save some money or not. Next question is, promoter increasing stake in his own company is an indicator of sectoral tailwind? Well, it can be. It can be, yes. Rather, more often than not, research studies have shown that it is an indicator. Yes. Suppose we get one multi-bagger stock means what is the indication to sell the stock? We have talked about it. Sometimes the wait can be so long to realize the returns. Yes, infra between 2010 to 2020. Yes. Do you have any threshold time to exit the wait in your PMS even the conviction remains solid? Well, as long as there is conviction, you should stay invested. So far, we are also testing our conviction in one idea which we have invested for almost 3, 4 years, and we are still waiting returns. But since conviction is there, balance sheet is strong, management is fantastic. Business went through a tough phase right after we invested, so we were plain wrong in our assessment there. But valuations continue to be very attractive, and we are invested. If valuations are, which go up, and we sense that valuation risk return is not in our favor, we may exit. Difficult to call out a particular time period because it is difficult to predict the business cycles. In today's world, when all information about any company is available to everyone, is there something called undiscovered company? Yes, we have seen that. There is something called undiscovered. The reason why there is still a chance of finding an undiscovered company is unless a lot of money chases a particular idea, the stock doesn't get re-rated. Unless there is a lot of money chasing at the in a short period of time, demand supply is in favor of demand, is in favor of the share price. Stock won't get re-rated or discovered properly. Also, discovery means being discovered by big institutional houses, wherein they have research, equity research firms writing reports on them, management coming out for conference calls and talking about their company to everyone at the same platform, and big research mutual fund houses or big FIIs investing in them. And that cannot happen. Big money cannot come in a 100, 200, 300, 500 crore company. Big money cannot come there just because there is no liquidity there. How can 100 crore of, if we are a big fund, let's say 10,000 crore in size, and I want to invest just 1% of the fund, which is 100 crores in a company, I will never go to a 500 crore company. I will have to buy 20% of that, right? So because of this aspect, there is a technical constraint here. A company remains undiscovered. Yes, a lot of retail individual investors may be able to find it and invest in them, but they're investing a couple of crores in them, few lakhs in them, few thousands in them. The company remains undiscovered. Nobody is still talking about it at a great level. But when the earnings of such undiscovered companies grow up, and we have had multiple such companies in our portfolio, and that's where the joy of investing lies for us in investing, actually. And that's why we end up spending 95% more than that of our time in such companies. That, when such companies grow, their profits become sizable, that's when they become attractive for big investment houses or big investors. And that's when they become discovered. And you have also the extended part of the question is, if a company is undervalued, it means that the company deserves such low value. Well, if we say that, we are also in a way saying indirectly that markets are efficient. Markets are efficient most of the time, but sometimes they are not. And that's when you take leverage. We have seen time and again, and the data says it. Entry valuations are low at that for all the multi-baggers that we have seen in the last 10 years, and they went on to become multi-baggers, and entry valuations went up from those levels where they were at the beginning of the study 10 years back. So yes, there are companies which are undervalued, but I think probably you're trying to ask this, and yes, I think this is what you mean, probably that during at that point in time entry valuations are low because they deserve it, because they are going through a tough phase. When the tough phase will be over, valuations will respond accordingly. So you need to be early. That's what we said. This is one of the traits of a multi-bagger, that you might be early because you are trying to buy companies which are neglected by the market. Anything which is neglected will have good valuations, but it may mean you may be early. And we saw in the case of TD Power, since the sector was neglected for almost 7, 8 years by 2018, and another 3, 4 years, only in last 2, 3 years that we are seeing a capital goods sector is becoming the darling of the market. So for almost 8, 9 years, and we were We invested in the first seventh year. So another eighth and ninth year we had to sit through, despite company doing well. You have seen that margins were expanding, sales was growing, but company was still down. So it was cheap, but does that mean it deserved to be cheap? No. And this is what happened when markets discovered it. It has started to go up. And exactly in the same question, I will answer your first part through the data and the information that we have. When we invested, it was 300 crore or around about that market cap company, and no, it was undiscovered company. No investor wanted to buy. Whoever had invested was selling, so people actually dumped that company altogether, and it became from discovery to discovered to undiscovered, because nobody wanted to look at such a small company which institutional investors were selling whoever invested at the time of IPO. But when the company started to do well for 2 3 years, when the market profit started to go up, when the market cap started to go up and became sizable company, again mutual fund investors started coming in. Again, it became a company which now people are talking about, which research houses are writing a report about. When we invested, there was no research on this. So yes, company became from undiscovered to discovered. And there are many more examples. I am talking about TD Power again and again because we have talked about it on our slide. Which entry strategy do you use for which scenarios? When do you deploy in one go versus when do you accumulate? It perhaps has to do with conviction, but what qualifies as high conviction for you? See, high conviction means you are sure that the risk is very much limited and returns can be interesting. And conviction comes with time. So there are companies which we have been tracking for many, many years. We recently invested in a company, and even after investing for many years, you may not get the right or evaluating the company for many years, you may not get the right valuation. So you also have to sometimes wait for valuations to invest a high amount of money in that, high amount of capital in that company. So it's a combination of both your conviction, the business execution, as well as the right valuations. So conviction, comes with time, over time, and seeing the thesis playing out in terms of business execution and how the company has done during the bad phases, which comes from reading the history. So a question from YouTube chat, how this process will synchronize with market cycles and Fed actions on monetary policies? It doesn't have to synchronize the process. Process is process. It is irrespective of market conditions. You focus on your process, which we have laid out very well and talked about it multiple times. And that process in the last 10 years has seen multiple Fed policy cycles or actions and market cycles and business cycles, and it has worked very fine. And we believe it will continue to do well. And we continue to strengthen our process as years go by. As we learn new things, we continue to incorporate those learnings. What is the starting point to have multi-bagger? We have talked about it. We have talked about the other question as well. Can investing long term in mutual fund compensate multi-bagger return? Investing long term in mutual funds compensate. So yes, it can. However, you need to invest with the right set of mutual funds. Yes, it can. Because if you generate, what is multi-bagger actually? Multi-bagger is nothing but investing, being invested for a long period of time and generate decent returns every year. Let's say even if you generate 20% returns after 12 years, your stock will be almost to for 8 bagger. Just imagine 20% returns in 12 years will give you 8 bagger, which is fantastic. So, and similarly, 15% returns in 15 years will give you 8 bagger, which is fantastic. How do you find the company that presents the data is really honest? Well, we do many checks on the data. We go through last 10 15 years of annual reports, rigorously evaluate quantitative and qualitative aspects from the annual report and the data, and you are able to get rid of 80 90% of such companies where you think management is not honest. Still, there are some cases where you need to do promoters check, and every company we try to do that. We over the years we have built a network of industry professionals and very good fellow investors, and we get good feedback from them, and that's how we try to evaluate whether the company is honest or not. Uh, Just a curious question. Was there any company after you exited came back and surprised you? Yes, there have been, like I said, selling is the hardest part. There have been cases when we exited a company either because we thought it is not a good company that we invested in, or we thought it is expensive. After making some money or a lot of money, we sold. In both the cases, there are many cases where we saw the companies going up. However, there are many more cases where we saw that selling was the good thing. Overall, we need to look at, so see, these mistakes will continue to happen. We need to look at the overall portfolio approach is what matters. So if as a whole we have been able to do justice to the portfolios, that's what matters. Mistakes will happen. In the mistakes, what we need to focus is how much money are we losing. If we are making big mistakes and small, I would say, outcomes. If the end output is that big mistakes and small good outcomes, then we are doing something wrong. But if we are able to contain our mistakes in a limited zone, that's how you make money. Because if you are able to do that, which means you are losing less money whenever you commit a mistake. And if you get couple of very good outcomes, that's when you make a lot of money and overall outcome becomes very heartening. Many multi-baggers do not have con call. Then what can we do? If we see drops in quarter, what's your view? Sometimes you don't get access to management meetings, but once a year, AGM happens. And in addition to that, you can try to do some plant visits. As a group, you can approach the management team that you are significant shareholders, and you try to meet the management. And that's what we have done. And there have been multiple such undiscovered companies, literally undiscovered. They were lying in plain sight, and you just need to go to them and read their annual reports. And they don't do con calls and all of that. So you just go to them, try to convince the management that you are really after understanding the business and you are not focusing on next quarter returns and all of that. You try to understand the business more and more through the numbers, and they appreciate it, because we are also able to give them some business insights, because they are a lot focused on their own business. But we go to them with the industry insight, with the competitive analysis that we have done, and which is also valuable to them. So in a way, we are also able to add some value to them, and we can give them a very interesting or very useful market perspective. So because of our value additive portion, we are able to get some management meetings and we are able to understand from them. And this is what you can do. And sometimes you don't get to know anything, and you just need to go by whatever understanding you developed about the business and the industry. Can banks be multi-baggers? Banks have been multi-baggers, yes. I have few which have moved 5x since COVID, but do they really move up? Yes, they do move up. I mean, PSU banks have a history of returning so much of money from 2003 to 2008. Private banks have been making money ever since. Look at HDFC, Kotak, and the likes of it. Oh, well, that was the last question. So, with that, we come to the end of the presentation. If there are still more, you can reach out to our team. I just show it up here. Mm, just a second. Okay, I'm not able to share the presentation somehow, but you can reach out to our team. Our email ID is pms@ithought.co.in, and our phone numbers are 9500027285. You can reach out to us and we'll be happy to respond to all your queries which are left. Well, with that, we come to the end of the session. Thank you so much for joining us on a Saturday evening and for this long webinar. We have taken almost 90 minutes. Thank you so much. Wish you a good evening and happy Sunday. Bye. Tarun, we can close it.
Yes, sir. Thank you, sir.
Thanks.